We've been covering the story earlier, the credit default swap market sending a message about Morgan Stanley. And the message is that the bank is less credit-worthy than most banks in the U.S. and the UK and is as risky as the biggest lenders in Italy. Matt McCormick is with us now. He's a portfolio manager at Bahl Gaynor. He is with us from Cincinnati. Matt, you pretty much agree with the credit default swap, it seems like, from your research, from one of the notes that we've been exchanging. Why is that?
Well, when you look at Morgan Stanley, you look at where the potential risks may be, and the market is clearly indicating that there is a pause for concern. It's down roughly 34% quarter to date. And what I think a lot of people have been talking about is their exposure to France that some people feel is bigger than their entire market cap. But what's really interesting to me is you look at the derivatives exposure, which is roughly 1.8 trillion, and that's with a T, of which 98% is involved with foreign exchange contracts, which are a little bit more riskier. And I think when you look at that type of exposure, a lot has to go right for that trade to be positive. I think a lot can go wrong for that trade to end badly for Morgan Stanley, and obviously many other investors share my concern. And my opinion is you don't have to own these companies. There's more risk versus reward. I would look elsewhere, particularly dividend-paying stocks.
Dividend-paying stocks, and you point out this risk and reward. So I feel like I should also say, just for a devil's advocate point, that Morgan Stanley's capital position is the strongest it's been in something like 7 years. I mean, they do have a lot of margin for error, but I just heard you say it's still not enough because you just don't know what's out there.
I look at this from a risk management perspective, Deirdre, and I think when you look at the market, when you see Morgan Stanley's outside performance to the downside this quarter, and clearly this has been a very difficult quarter for financials, and I think next quarter will be also difficult, the market's telling you something. They don't care about cash reserves. They don't care about management saying everything's okay. They look at what's happening in Greece and they say it's unlikely to end well. They predict there's going to be more volatility, not less. If Greece defaults, that's going to impact Europe. It's going to impact the money center banks. It's going to impact the 1.8 trillion in foreign exchange derivative contracts. It's going to impact all the financials to the negative. And again, our thoughts are, why don't you mitigate that risk? Why take that when there's other areas you can go that you can preserve your capital and get more income?
That counterparty risk is certainly a big part of running any bank these days. To your point, Matt, I heard you say you like dividend-paying stocks. I have to admit, the last trading day of the week and of the quarter, stocks have just suffered so much, and stock investors have suffered so much this quarter. How can you make the argument for U.S. stocks at this juncture?
Well, I look at over the next 10 years, and you look at money markets paying 0%, and the 10-year Treasury roughly at 1.8, and it's very difficult to live when costs only seem to increase. And I've never had a client say, Deirdre, I have enough income, I need more. And I think dividend-paying stocks give some downside protection, some more income. You look at stocks like Intel, Procter & Gamble, or McDonald's, they're actually up this quarter, and they all pay dividends above 3%. And more importantly, they grow them on a regular basis. And I think that's what clients and investors are really focusing on, saying, hey, if I can't stay in cash and bonds really aren't going to pay for me for my lifestyle going forward, I want to get a risk premium of, say, 2% or higher on the dividends. And I think people, if you have dividends, you have to have earnings to pay them. It may not be a ton, it may not be huge, but it's enough to pay you more every year. And I think in the long term, a lot of investors are saying, you know what, if I'm going to invest in stocks, I want the bluest of the blue chips. I want big dividend yields. I want to avoid issues like Europe and the money center banks, which I think are going to end badly. Why not go in companies that have ubiquitous products, big brands, and they pay you more every year? And I think a lot of investors say, you know what, I don't want to hit the home runs. I'll take singles and doubles, and I think that approach is going to work for, frankly, the next several years, Deirdre.
Matt, as a portfolio manager, though, even though your reasoning may be sound, how frustrated are you that all U.S. stocks, no matter what dividends they're paying, no matter how healthy their balance sheet, they're all trading as one single currency right now?
There's about a 90% correlation in the market to the SPX, and it's something when you look from an individual size, companies have a lot of cash on their balance sheet. Management is becoming more positive, but I think you're dealing with a macro crisis of confidence that, frankly, is the political leaders on both sides of the aisle and, frankly, worldwide are not doing their job. And I think that's something that's causing many investors to have pause for concern. It's causing many CEOs to say, I'm going to hold off for a little bit. And I think you're looking at a grinded-out market for a while until you see some resolution, some confidence from the politicians. And, frankly, I don't have much confidence in them.
All right, Matt, it sounds like you have to be patient if you're in stocks right now. Thanks so much for joining us. Matt McCormick is with us from Bahl Gaynor, joining us there from Cincinnati. He is a portfolio manager. You heard him say, in his view, the best picks are dividend-paying stocks because the markets are going to act a little bit wild for a few more months at least.